We just finished going through Alphabet's fiscal 2026 Q2 earnings call materials, and now we want to sit down and share what we're seeing with you. Here's the number that stops you cold. Revenue came in at $119.8 billion, up 24%. Operating income up 30%. Gorgeous, right? Now, here's the part nobody puts on the poster. Free cash flow went negative, minus $5.9 billion. Let me walk you through this one slowly, like I'm teaching it, because that gap is the whole story and I want you to see it the way I do. The deck lays it out as two columns, and I respect that they didn't hide it. On the boom side, the company reported revenue of $119.8 billion, up 24%, and operating income of $40.8 billion, up 30%. The filing calls this the 12th straight quarter of double-digit growth. Think about that. 3 years without a stumble. Then the burn side, and it stings free cash flow at negative $5.9 billion, and full-year capital spending revised up to a range of $195 to $205 billion. That's the gamble right there in the title. Alphabet's own framing is that they're deliberately sacrificing today's cash flow to lock up AI, compute, and market share. Here's my read. This isn't a company in trouble. It's a company making a choice. The whole question, and they say it flat out, is what has to go right for this bet to pay off. Hold that question. We're going to answer it page by page. Now let me show you where the money actually comes from, because it's 3 engines, not one. Search through of $63.3 billion on, up 17%. The company calls it the cash cow, and honestly, that's fair. YouTube did $11.1 billion across ads and subscriptions, and Google Cloud $24.8 billion, up 82%. They nicknamed it the hyper engine, and you'll see why in a minute. But here's the part the deck really wants you to notice. Underneath all three sits what they call the full stack AI factory, their own chips, the TPU, their own models, Gemini, and their own cloud infrastructure. The company's claim is that they're one of very few players who own the silicon, the model, and the distribution channel all at once. Our take, that vertical integration is the real thesis of this whole story. And the slide says this stack is turning from a support system into a fourth business line. That's a big statement. File it away, we'll test it as we go. The company reaches for an analogy here, and it's a good one, so let me borrow it and walk you through it. Picture a power plant. The generator is the TPU chip. The power plant itself is the data centers. The appliances that run on the power, that's Gemini, Search, YouTube, and the enterprise tools. The mechanics, per the slide, are simple. Alphabet designs the generator, builds the plant, and manufactures the appliances, all of it in-house. Now the pivot, and this is the interesting bit. Historically, that electricity was strictly for their own use. Now they're renting out the grid, that's cloud, and selling the generators themselves, the TPUs, to outside clients. And the catch, which the deck prints in red, is that this model eats massive upfront cash for land, hardware, and construction years before a dollar of revenue shows up. See it? The power plant is what explains the negative cash flow. You don't get to bill anyone while you're still pouring the concrete. Okay, pay close attention here, because this page is doing real work under the surface. The company reported total revenue of $119.8 billion, up 24% and up 23% in constant currency. Genuinely strong. But look at what's sitting inside the profit line. There's $98 billion tagged as other income and expense, and a big chunk of that is unrealized equity gains. Unrealized meaning paper, meaning it isn't cash in the door. The slide's own footnote says net income and EPS were heavily inflated by paper gains, not core operating cash. To be fair to the bulls, the underlying businesses really did fire. Services at $94.5 billion, cloud at $24.8. That part is rock solid. But here's my read, and it's the honest one. When the only metric management downgraded was cash flow, and paper gains are puffing up the headline earnings, you trust the cash number more than the EPS. Cash is a lot harder to dress up, and I'm maybe 80% on that call. Now the question every Google skeptic asks, doesn't AI just kill search? The deck meets it head on, and I like that. The bear's case, and it's a real one, is that AI answers cannibalize the traditional search click and the ad space around it. If the machine just answers you, why would you ever click an ad? Fair. Worry now. Here's the Q2 reality. The company put up base search ad revenue of $63.3 billion, and search ads grew 17%, driven by retail and finance. AI mode is already past 1 billion monthly active users. And their claim is that the global rollout since October actually created net new query volume, sending billions of weekly clicks back out to websites. The word they use is additive, not dilutive. My honest take, 1/4 of 17% doesn't settle the debate forever, but it does tell you the cannibalization the bears feared simply hasn't shown up yet. And that little chart, AI mode query cost falling, that matters too, because cheaper answers means the math keeps working. This is the page that made me sit up straight, so slow down with me. The company reported a cloud backlog of $514 billion. That's contracted business not yet recognized, and it jumped more than $50 billion in a single quarter. They expect to recognize more than half of that within 24 months. Meanwhile, Q2 cloud revenue was $24.8 billion, up 82%. But revenue growth is easy to buy. Margins are the real tell. Operating margin went from 20.7% a year ago to 35.6% this quarter, and operating income more than tripled to $8.8 billion. That's the hyper engine label earning itself. The slide's point is that this growth is locked in multi-year contracts, not a one-quarter fluke, and marketplace transactions grew 7-fold year over year. Here's my read of everything in this deck. This is the strongest hand they hold. If you're bullish on Alphabet, you're really bullish on this exact page, and I'm about 85% that the backlog is the real deal. Here's a phrase that showed up over and over on the call: supply constrained. The company says it's processing 22 billion API tokens a minute, up from 16 billion just last quarter. 9 million monthly developers and 500 plus cloud clients, each burning more than 1 trillion tokens. The product pipeline runs Gemini 3.5 Flash Lite, then 3.6 Flash, and then Gemini 4, which they call their largest pre-training run ever. Now think hard about what supply constrained really means. On one hand, it's a beautiful problem. Demand is outrunning what they can build, and that basically guarantees near-term growth. But, and the slide says this itself, it forces the ugly pivots, hiking capital spending hard, and even renting third-party compute just to bridge the gap. So the moat and the cash burn are the same coin, two sides of it. Being sold out is exactly why the free cash flow is negative. That's not a contradiction, that's the strategy working as designed. Let me actually do the arithmetic with you, because this is the page that demystifies the scary headline. Start with operating cash flow, a healthy $39.1 billion, that part is strong. Then subtract the capital spending. Servers and compute, roughly $26.9 billion, that's 60% of capex. Data centers and networking, about $18 billion, the other 40%. Do the math, 39 minus 27 minus 18, and you land right at negative $5.9 billion. See, it's not that the business stopped making money, it's that they spent every dollar it made, and then some on infrastructure. Now the company flags two warnings for us. One, a triple margin threat in Q3, third-party compute rentals, with integration costs, and rising depreciation and energy. Two, a timing gap, TPU system sales eat inventory cash now, but the revenue only lands on delivery. Our read, the negative number is fully explainable, but Q3 could look worse before it looks better, so keep your eyes open. So who actually gets these chips? The deck ranks it for us. Priority 1 is internal AGI development. They keep the best silicon for their own frontier models. Priority 2, internal services, search, YouTube, cloud. And priority 3, the emerging one, is selling TPUs to outside enterprise data centers. They name a Blackstone partnership as the example. Here's the part investors need to hear clearly. Management explicitly frames external TPU sales as a way to expand the total addressable market, not just pad this year's margins. And the timing matters. The slide says the vast majority of that external revenue shows up in 2027. It's booked inside the $514 billion backlog, but only a sliver is recognized today. So keep your expectations honest. The TPU-as-a-product story is real, but it's a 2027 event, not a 2026 one. To be fair, that's exactly why they can spend so hard right now. They're building for a payoff that's 2 years out. This page is the most honest one in the whole deck, and I genuinely respect it. The argument is about where the moat actually lies. If you're just selling a model, the slide calls that the commodity trap. Open source catches up, features get copied, and you're stuck in a price war. Alphabet's pitch is the full stack, instead custom silicon at the bottom, then data confidentiality, then agentic orchestration, then vertical products like Chronicle, Wiz, and Gemini Enterprise on top. Their claim is that the battlefield moved from single model benchmarks to full system enterprise utility. The model is just raw material. The stack is the moat. Now here's the crack, and credit to management for printing it themselves. They admit plainly that Alphabet is currently lagging in raw coding and agentic coding, and Gemini 4 is positioned as the catch-up. My honest read, the full stack moat is credible, but that coding gap is exactly the kind of thing that bites you in enterprise deals right now. I can't fully call this one until Gemini 4 actually ships. I love this page because it teaches you to translate management speak, and that's a skill that saves you real money. 3 claims, 3 reality checks, color-coded. First, AI monetization. Management says AI is already profitable, cloud up 82%, search up 17%. The deck's own verdict, hard data backs it, highly credible, green. That's the easy one. Second, the moat. They say full stack integration is their defense. Verdict, mostly true, but the coding weakness leaves real enterprise holes in the short-term yellow. Third, and this is the one to tattoo on your hand, capital allocation. Management says disciplined returns more bullish than a year ago. The reality check is brutal, and I agree with every word. More bullish is PR for we're hiking capex and turning cash flow negative. And the true return on capital can't even be validated until 2027 red. When a slide grades its own management red, you stop and listen. Now, this is a clever slide. It maps the Q&A by how often analysts pushed and how much management dodged. 2 questions got straight answers. On model frontier and coding, asked 3 times, management was surprisingly direct in owning the current lag. That honesty we already saw. On capex and supply, asked 3 times, they were firm and confident, demand's healthy, contracts are locked, spending continues. Good, clear, no games there. But now the dodges, and the dodges tell you where the soft spots are. Waymo spin-off? Asked deflected. They just kept repeating that they're focused on scaling. And the big one, TPU margins. Analysts asked 4 separate times. And while they confirmed the roadmap, they explicitly refused to give the margin on the product itself. Here's my read. When a management team will happily discuss everything except the unit economics of their hot new product, that silence is data. I'd want that TPU margin number in hand before I got too excited. Alright, let's put all the worries into one frame. The DEX own 4-point risk radar, which ties right into what radar does. Risk 1, cash flow timing. Free cash flow is negative today and faces that Q3 triple squeeze, while the TPU money that offsets it doesn't arrive until 2027. Risk 2, the 2027 capex bet. They raise spending again, and if pricing power in that new market weakens, the return on this historic outlay just collapses. Risk 3, the search-based Q3 runs into brutally hard year ago comparisons plus mild currency headwinds, so growth naturally slows. Risk 4, model competition. The frontier moves fast, and if Gemini 4 doesn't close that coding gap, the enterprise moat cracks. Now notice something the slide doesn't spell out. 3 of these 4 risks are really the same risk wearing different clothes. It's all timing. They're spending certain money today for uncertain money in 2027, and that is the bet in a single sentence. Zoom all the way out because this page reframes everything we just covered. The company puts the whole AI build out on an S-curve. Phase 1, early R&D, that's the past. Phase 3, application maturity, that's 2027 and beyond. And Phase 2, the infrastructure land grab, that's where they plant the flag reading you are here. That single positioning explains every weird number we've looked at today. Hoarding TPU inventory, spiking capex, renting other people's servers. The slide says it all points to one directive. Grab capacity and lock clients into multi-year deals and treat short-term cash flow as the thing you're willing to sacrifice. And then the line I'd underline twice. They say the $14 billion backlog is the only metric that matters for justifying today's cash burn. That's the deal they're offering investors. Judge us on the backlog, not on the free cash flow. Whether you take that deal is basically the whole investment decision. Last content page, and it's the useful one. The company hands you a 6-point scoreboard to hold them to. 1. Backlog conversion. Watch, the $514 billion target is more than half recognized within 24 months. 2. FCF rebound. Operating cash flow back above capex, so free cash flow turns positive again. 3. Capex discipline. Stay inside that $195 to $205 billion ceiling, no creeping higher. 4. Cloud margin defense. Hold the 35.6% line even with Wiz and compute cost biting. 5. TPU monetization. Real hardware volume scaling up into 27. 6. Search resilience. Keep core ad growth near 17% despite the high base. Print this list because these 6 numbers are how you'll know quarter by quarter whether the bet is working. You don't have to guess. Alright, last thing. Radar always leaves you a light. Weighing this whole deck, the growth is genuinely spectacular, the cloud backlog is a monster, and management is unusually honest about its own weak spots. But the free cash flow is negative, the payoff is parked in 2027, and they told you flat out to judge them on a backlog instead of on cash. That's a wonderful business caught at a moment of maximum spending and maximum uncertainty. I'm calling this one yellow. Not because it's bad, because the good news is already real and the risk is all about timing. If they hold that capex ceiling and the backlog starts converting on schedule, I flip to green, and I'm telling you that up front. But if capex breaks the ceiling or those cloud margins crack, that's exactly when I'd step aside. If you like this kind of analysis, it's the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.